Hello, brilliant minds and curious learners. Ever wondered how Kamala Harris's 2025 tax plan might affect your wallet? Well, you've come to the right place. Today, we're delving into the intricate details of this plan, dissecting 6 key changes it brings to the table. From corporate tax hikes to capital gains tax, child tax credit expansion to unrealized capital gains, estate and gift tax changes, and finally, the increased Medicare and investment taxes. So buckle in, because we're about to dive deep into the world of tax policy. First up, we've got the corporate tax rate increase. Cue the gasps. Now, this isn't a horror movie, but for some, it might feel like it. We're talking about a proposed leap from the current 21% corporate tax rate to a whopping 28%. Yes, you heard it right. That's a 7% hike. Now, let's break it down. This increase is primarily aimed at large corporations, the ones with the fancy logos and skyscraper headquarters. The idea is that by having these big players contribute more to the tax pool, there will be more revenue available for public programs. Sounds simple, right? Well, as with most things in life, it's not that straightforward. While the extra revenue might indeed be used to fund much-needed public programs, we must also consider the potential impact on these corporations. Now, don't get me wrong, I'm not asking you to lose sleep over the plight of multi-million-dollar corporations. Still, it's worth understanding that corporations might react to this tax increase in several ways. Some might choose to absorb the cost, but others might decide to pass it on to their consumers in the form of higher prices. And here's something else to chew on. Corporations might also become less inclined to invest in new projects or expand their operations. After all, the more they earn, the more they'll have to fork out in taxes. This could potentially slow down job creation within the U.S., which is a significant consideration in the grand scheme of things. But remember, this is not a done deal yet. It's a proposal, a part of Kamala Harris's 2025 tax plan. It's an attempt to balance the scales, to generate more public revenue from those who have more to give. So that's a hefty load for the big guys. But what about the individual? Stay tuned to find out. Next on our list is the capital gains tax. This is the tax you pay when you sell an asset for more than you bought it for. In simpler terms, it's the tax on the profit you make from selling something you own. Now, under Kamala Harris's 2025 tax plan, there's a significant change in this area. For individuals earning more than $1 million annually, long-term capital gains and dividends would be taxed at a higher rate of 28%. That's a big jump from the current long-term capital gains tax rate of 20%. This means if you're in this income bracket and you sell your shares of a company for a profit or receive dividends from your investments, you'll be paying more in taxes. Why the increase? The intention behind this proposal is to reduce income inequality. The idea is that by taxing high earners more, the government can redistribute wealth more evenly across society. This is a move that's aimed squarely at the wealthiest 1%. But as with any tax change, this proposal has sparked some debate. Critics argue that this could deter investment from high net worth individuals. After all, if the profit you make from selling an asset is taxed more, you might think twice about investing in the first place. On the other hand, supporters of the plan argue that the current capital gains tax rate disproportionately benefits the rich, who are more likely to make money from investments compared to lower-income earners. They believe this change will make the tax system fairer. However, it's important to note that this change won't affect everyone. If you're earning less than $1 million a year, the capital gains tax rate remains the same. So for most people, this change won't impact their tax bill directly. But it could have indirect effects. If high net worth individuals pull back from investing, it could affect the overall economy. This could mean less money for businesses to grow and create jobs. On the flip side, the increased tax revenue could be used to fund public programs, which could boost the economy in other ways. In conclusion, the proposal to increase the capital gains tax for high earners is a significant part of Kamala Harris's 2025 tax plan. Its impact on income inequality and investment is yet to be seen. As with any tax change, it's a balancing act between raising revenue and encouraging economic growth. If you're enjoying this video so far, don't forget to hit that subscribe button and ring the notification bell. Now let's move on to how the tax plan helps families. Let's talk about the child tax credit expansion. Now this is a part of Kamala Harris's 2025 tax plan that really hits home for many families. Remember the enhanced child tax credit that was introduced during the pandemic? Well, it's making a comeback. Under this proposed plan, families could receive up to $6,000 for children under 1 year old. I mean, let's be real. If you've got a baby, you know how those costs can add up. Diapers, formula, not to mention setting up a college fund. This boost could be a real game changer, but it doesn't stop there. If you have children aged 2 to 5, you could receive $3,600. And for those with older children, you're looking at a cool $3,000. It's almost like getting a bonus for those sleepless nights and endless rounds of why. But what's the aim here? Well, it's all about supporting low and middle-income families. This plan recognizes that raising kids is expensive and that everyone could use a little help. It's about creating a more equitable society where every child gets a chance to thrive, regardless of their family's income. Now, as with any plan, there's always a but. There are questions about how to fund such a generous credit and what the long-term effects might be. Will it discourage work? Will it lead to higher taxes elsewhere? These are valid concerns and will no doubt be part of the ongoing conversation about this tax plan. But let's not get lost in the weeds. The big picture is that this proposed child tax credit expansion could provide some much-needed relief for families. It's a recognition that our little ones are indeed our most significant investment, and they deserve all the support they can get. So, big relief for many families out there, but we've got more to cover. Now, let's tackle the tax on unrealized capital gains. Imagine yourself as a billionaire. No need to pinch yourself, it's just a hypothetical scenario. As a billionaire, you've got an impressive collection of assets, from stocks and bonds to real estate and, who knows, perhaps a rare piece of art or two. Now, traditionally, you wouldn't have to pay any taxes on the appreciation of these assets until you sell them and realize the gains. This is what we call unrealized capital gains. But under Kamala Harris's 2025 tax plan, that's all set to change. The plan introduces a concept called the Billionaire minimum tax, which is a bit like a cover charge at an exclusive club, only for the ultra-wealthy. This tax imposes a 25% levy on unrealized capital gains for individuals with over $100 million in assets. That's right. Even if you haven't sold off your assets, the taxman will still come knocking. Now, you might be wondering, why this change? The answer lies in the fact that many wealthy individuals have been able to avoid paying taxes by simply holding on to their assets without selling them. This tax on unrealized capital gains is aimed at closing this loophole and ensuring that the ultra-wealthy pay their fair share of taxes. However, as with any financial policy, there will be potential impacts. On one hand, it could lead to a significant increase in tax revenue, which could be used to fund public programs. On the other hand, it could force the wealthy to liquidate assets to cover the tax bill, potentially affecting the stability of financial markets. But let's not forget, the primary goal of this tax is to address tax avoidance and promote economic fairness. It sends a clear message that no matter how high you climb on the wealth ladder, you can't dodge your tax obligations. That's the gist of the tax on unrealized capital gains. It's a bold move, certainly, and one that could shake up the way the ultra-wealthy manage their assets. As with any policy, it has its pros and cons, and its actual impact will only be seen once it's fully implemented. If you find this content valuable, show some love by hitting the like button. Your likes not only encourage us to keep producing these informative videos, but they also help more people discover this content. So go ahead, give that like button a tap. It won't cost you a dime, I promise. Now it's time to move on to estate and gift taxes. Get ready, because this is another area where the 2025 tax plan promises some significant changes. On to the next one, estate and gift tax changes. Kamala Harris's 2025 tax plan doesn't stop at taxing the living. It takes a serious look at what happens to wealth when the well-off pass on. Currently, the estate tax exemption sits at a hefty $12.92 million. This means that a person can leave up to that amount to heirs and pay no federal estate or gift tax. Under Harris's proposed changes, this exemption would shrink considerably, down to $3.5 million. The plan also suggests a potential increase in the estate tax rate, which could climb as high as 65% for the largest estates. Now, you might be thinking, what does this mean for me? Well, if you're in the high net worth category, these changes could significantly impact how you plan for wealth transfer. It's not just about estate planning anymore. It's about tax planning on a whole new level. Imagine this. You've worked your whole life building up a nest egg. Maybe it's a successful business, a diverse stock portfolio, or a sprawling real estate empire. You've planned to pass it all on to your children to give them a head start in life, or maybe just to ensure the family legacy continues. Under the current laws, you could pass on up to $12.92 million of your fortune without your heirs having to worry about federal estate or gift tax. But under Harris's proposed changes, anything above $3.5 million could be subject to an estate tax of up to 65%. That's a significant portion of the family fortune that could end up in Uncle Sam's pocket instead of staying in the family. Now, it's important to remember that these changes are aimed at addressing wealth inequality. The goal is to reduce the concentration of wealth and create a more level playing field. However, for those affected, it could mean a serious rethink of how to pass on their wealth. The potential impacts of these changes are far-reaching. They could lead to a shift in investment strategies, with high net worth individuals seeking out ways to minimize their estate tax liability. This might include gifting assets during their lifetime or moving assets into trusts. But it's not just about the rich. These changes could also affect businesses, particularly family-owned ones. If a significant portion of a business's value is tied up in non-liquid assets like property or machinery, the heirs might have to sell off parts of the business to cover the estate tax bill. As with any tax law change, there are potential benefits and drawbacks. It's a complex issue, and one that will undoubtedly continue to provoke debate as the details of the plan are hammered out. So passing on the family fortune just got a little trickier, but wait, there's more. Last but not least, we have increased Medicare and investment taxes. Let's dive into the deep end of this pool, folks. Once upon a time, there was a tax bracket that began at the magical number of $400,000. Now, if you're lucky enough to find yourself in this illustrious group, you might want to brace yourself for what's coming next. Under Kamala Harris's 2025 tax plan, if your income exceeds this magical number, you're about to see higher taxes. The Medicare tax rate, which currently stands at 1.45% for employees and employers each, is set to increase. Now, don't get me wrong, Medicare is a great cause. It's all about providing health insurance for the elderly and the disabled. But if you're earning over $400,000, you're about to become a bigger part of this cause, whether you signed up for it or not. But wait, there's more. Not only is the Medicare tax rate going up, but the net investment income tax, or NIIT as the cool kids call it, is also set to expand. This tax currently applies to certain net investment income of individuals, estates, and trusts that have income above statutory threshold amounts. Sounds complicated, right? Well, let's break it down. The NIIT is a flat-rate tax of 3.8% on things like interest, dividends, capital gains, rental and royalty income, and certain annuities. It's like a tax on your tax. Now, under the new plan, the NIIT is set to include more types of income. So if you're in that $400,000 and above club, you might want to take a closer look at your investment portfolio. So what does this all mean? Well, in simple terms, it means that wealthier households are going to be hit with higher taxes. The aim is to balance the scales a bit, reduce income inequality, and generate more revenue for public programs. But it also raises questions about the impact on investment and economic growth. Some argue that this could deter investment and slow down economic growth. Others, however, believe that it could lead to a more equitable distribution of wealth and help fund vital public services. The jury is still out on this one, folks, but one thing is clear. If you're earning over $400,000 a year, your world is about to get a little bit more expensive. It's like being invited to an exclusive club, only to find out that the membership fees are going through the roof. So, a heavier burden for those at the top. Hope you enjoyed us venturing into the labyrinth of Kamala Harris's 2025 tax plan. And remember, knowledge is power, especially when it comes to understanding how your hard-earned dollars might be affected. So, there you have it, the crux of Kamala Harris's 2025 tax plan. From a corporate tax rate increase aimed at large companies to a higher capital gains tax for those earning over $1 million annually. We've explored the child tax credit expansion designed to support low and middle-income families, and a tax on unrealized capital gains that targets the ultra-wealthy. We've delved into the changes to estate and gift tax, impacting the transfer of wealth, and the increase in Medicare and investment taxes for incomes over $400,000. Each of these changes is designed with a clear purpose: to reduce income inequality and fund public programs like healthcare, education, and housing. But as we've discussed, they also raise questions about potential impacts on investment and economic growth. Thank you so much for watching. If you found this video helpful, don't forget to like, share, comment, and subscribe. And remember, stay smart, stay curious, and keep learning.